Hello, everybody. Good evening. I just wanted to let you all know that we're going to wait a couple more minutes and then start the webinar for everyone to be able to log in.
Hello, everyone from Montreal. And those of you who are already online and waiting for this to start, I'd like to personally invite you to, to ask your questions. I guess you're going to type them in and Derry will see them. Ask your questions as we go along. And if you need a precision on a specific slide that I am commenting on, and you feel you would like that answer before I move on, let us know, and I'll do
Exactly. Just write your questions down on the chat. You can find it on the control panel at the right bottom, and I will be keeping an eye out on it, and then I will be directing the questions to Philippe.
So I'll wait for your signal, Derry.
Yeah. Let's just wait maybe another minute, and then we can start.
Sure.
Okay. Then why don't we just go ahead and start, and then let people join in as we go forward. Again, good evening, everybody. Thanks for taking the time out to join us tonight. We have Philippe here from Cartier Resources. I won't be keeping this long and just handing it over to him. Mic is yours, Philippe.
Thank you. My name is Philippe Cloutier, and I'm President and CEO of Cartier Resources. I'm in Montreal right now in a hotel room and doing one of the last road shows of the year. I will essentially present to you today a three-part presentation. I want to remind our investors and our audience what we do and where we do it, and what our core strategy is. I want to point out in the general scheme of things where I believe Cartier is positioned along the value proposition graph. And then finally, most importantly, is give you a very rapid update of our most recent success on our flagship property, Chimo Mine. So here we go. This is the standard cautionary statement slide. Okay, so our strategy, and I'll support that with some figures and graphs here, is basically to prioritize exploration on quality projects in what we believe is the right jurisdiction, a jurisdiction that has demonstrated mineral endowment. And so we focus exclusively in the Abitibi Greenstone Belt on brownfields projects. Our current work, and the one we've focused on in the last 18 months, has been on the Chimo Mine project. And we have a longer dated growth opportunities, namely with three other deposits, Benoit, Wilson, and Fenton. And so our process is, once we've identified and acquired these projects, is to add value through exploration. So essentially to drill the gold zones. And we don't do any prospecting with the drill. We focus our exploration drilling directly beneath established or known mineralized zones. And our hope is that in doing so, we will clearly demonstrate new potential for these projects, and then we'll be able to monetize the value that we've created. and therefore reward our shareholders, and then repeat the process. That's quite simple. What does that look like on a graph? You've probably seen this graph many times over. It was actually an idea, I believe, by a gentleman by the name of Pierre Lassonde. It was modified and enhanced with various other authors. This latest one is a version that I've seen Mr. Brent Cook use. And it basically breaks down the exploration to development timeline into, 4 distinct periods. A period where you have a concept and you do grassroots exploration and then you discover things. A period where you've discovered something and you add value to it through exploration. And then you have a third period where you've decided either to take it to production or sell it to a miner. And then you'll see that generally the price of your shares drop, because we call that the orphan period, where people print a lot of shares and try to develop the mine. And then you have a period of where your share price enhances and when you're going into full production. And so when you've got a clear vision of where you are on that graph, as a management team, you could position and purchase projects that allows you to get yourself closer to the bottom of the slope, where I've indicated there, by Cartier, or this is where I think most of our projects are. You either want to be here and sell there, or here and sell there. So when I walk through this presentation, my hope is that I'll convince you that we've positioned our company here. We currently think that we're clearly undervalued, and I think I'll show that through the results that we've had. To build on that concept and why we acquired the projects that we acquired for our shareholders, I want to introduce a very fundamental concept. There's this one singular red dot up here in northern Quebec. That's the Eleanor deposit. And to give you an appreciation of the chronology, it was discovered in 2003, sold to Goldcorp in 2006, and poured the first gold ounces in 2016. So a 13-year period to generate wealth, but it remains isolated. And since it's quite remote, we call that frontier exploration. So bear with me, because this outline here in green, that's what we call the Abitibi Greenstone Belt. And I have a whole bunch of red dots in here, all right? And all of those red dots, and most of them are listed down here, Detour, Casa Berardi, Brace Mac, et cetera, et cetera. Well, those red dots are projects that in the same time frame, from 2003 to 2016, well, they are projects that were drilled, permitted, brought into production, and generated a lot of wealth. They're projects that were operated by juniors, and there were projects that were operated by seniors. There were projects that were small, high grade, and others that were large, low grade. In other words, there was enough for everybody. But there's one common denominator, and that is not one of those red dots was a new discovery like Eleanor. They were all deposits or past producing mines that had known better days and that were shelved or forgotten because of low metal prices, because of corporate strategies that the companies that had them pulled out, or any other reason. Not one of them was a new discovery, and we call that Renaissance exploration. And it has the capacity to generate a lot of wealth for a lot of people, and that's what we do. So in 2012, when there was a bear market that lasted about 3 or 4 years, we had $3 million, and we went on a shopping spree and purchased 4 of those red dots. I'm only going to talk about one of them today, but here they are, a focus on the Abitibi Greenstone Belt. And the 4 red dots are the Wilson deposit that we acquired for $42,000, a smallish historical resource of 50,000 ounces. The Fenton deposit that we acquired 50% of for no cash, but simply a commitment of exploration work with the government. And that deposit has about 100,000 ounces. And then we purchased the Benoit deposit for 250,000 ounces, and that has an estimate of about 250,000 ounces. But our home run was basically when we purchased the past producing Chimo mine. That was held by a company that went bankrupt. We were invited to the bankruptcy auction process, and we paid $261,000 for a past producing mine that had a historical estimate of just under 300,000 ounces. So you could see that we were able to acquire and control 4 deposits with demonstrated mineral endowment, ounces in the ground, for acquisition costs of about just $1 an ounce. So without further ado, I'm going to dive in and focus exclusively on the Chimo mine. Why we decided to focus on the Chimo mine in recently and not, spread our investment on all 4 projects. Well, the first reason is that Chimo is a 30-minute drive from downtown Val-d'Or, a well-established mining camp, so it's proximal to infrastructure and qualified workforce. And after we had decided that, well, we kind of noticed that these 3 other deposits up here, they are now part of intense exploration activity that is actually being borne by Osisko and Kirkland Lake mines. So here we go. We'll talk about Chimo. And for those of you who wonder what a drill site looks like in the forest, well, you have a bird's eye view here. You can see the drill. It's in yellow. The bulldozer just down here, and then the ATV. And so it's very smallish and clean, and we're proud that our environmental footprint is well contained. Chimo. Okay, here you have a map. On the top part of the map is a Google Earth, and all these blue dots are deposits, well-known deposits along the Cadillac Fault. And you can see that the Cadillac Fault kind of runs east-west in direction, and sorts of snakes, bobs and weaves. And the highway, the highway that goes from Val-d'Or down to Montreal, a 5-hour drive, kind of follows that fault. And the bottom part of the slide is a vertical slice that illustrates one of the key features along that fault, and that is that although the fault kind of controls where the deposit sits, well, within the fault, the main exploration vector and your target should be a steep vertical plunge. The Chimo mine is a deposit that's at the right hand, at the east end of the fault, and as you can see, the shafts on these deposits are the black lines, and Chimo goes down to just under a kilometer, and all the other deposits, Goldex, Lapa, LaRonde, and Westwood, well, they stretch down to 1.5 kilometers, 2, and LaRonde, you can see, goes down to 3 kilometers. I'd like to point out at this point that the Chimo mine was shut down in 1997, not for lack of ore, but because the price of gold in 1997 was $275 US, or roughly $400 Canadian. Although it was, still making money, it was barely doing so. And so they decided to shut down the mine and put it on care and maintenance. And by 2001, the price of gold still hasn't lifted. And so they sold it to another junior, and well, the rest is history. That junior went bankrupt, and we bought that. We bought the deposit for $261,000. And I will show you that our original thesis to drill beneath the main mine plunge and other satellite ore zones that were known, well, it turned out to be very good for us. And although it's not reflected in the share price, I hope you will see that we are an opportunity at this point. All right, some of the highlights of the project. We own 100% of this asset. There's a past production of about 380,000 ounces of gold. It's close to existing mining and milling operations in the region. Throughout the entire mine sequence, there were 14 zones that were partially mined by 3 separate producers. There was Chimo Gold Mines in the 1960s, and they produced about 60,000 ounces. There was Luvem in the mid-80s, and they produced about 90,000 ounces. And then finally, there was Cambior, who produced just around 200,000 ounces. And unfortunately, for that operator, they had to shut down, but they did leave leftover resources. The mine infrastructure there consists of drifts on 19 levels and a shaft that goes down to 920 meters. When we purchased this project, we went into a deep analysis of the data, and it took us about 2 years to generate a clear picture of what we were up against. And in that period of time, we attracted the attention of a senior mining company, Agnico Eagle, that ended up taking a 19.9% stake in our company for $4.5 million. And that, in turn, attracted the interest of JP Morgan in the UK and other institutional holders. So in a very short period of time, we went from having just under $1 million to $16 million. And then we launched an aggressive drill program focused on the Chimo asset. We started with phase 1. Phase 1 rewarded us slightly quicker than we had anticipated, and we went straight to phase 2, and we're currently in phase 2. All right. This slide is a bird's eye view of the mining project. In blue, right here, that little blue square, that's the shaft. All right. And you can see that the ore zones are contained in 3 separate shear zones: the north, the central, and the south. The black lines, well, that's ore that was mined out. It's no longer there, and there's about 380,000 ounces mined. The red lines are the zones that they had started to see, the extensions of the zones laterally and at depth. And so we had multiple targets there, and that was essentially phase 1. The phase 1 had 2 parts. One part was to drill deep down the main plunge, and the second part was to circumnavigate the shaft with 2 more machines and to try to identify which of the lateral zones was going to create additional ounces. So now we're going to look at a slide. The next slide is a vertical slice through these 3 shear zones, and it'll give you another dimension of what we're up against. So there you go. Again, you have the north, central, and the south clusters, shear zones. And within each of those shear zones, you have the mineralized veins. What is in black was mined out. What is in red is partially to totally defined ore. And so our program was to come at depth and test to see if this was, if there was continuity, and also test laterally. Again, you could see the shaft here that goes down to 920 and some of the drifts. So I'll give you some chronology here. The first mine in the 1960s was in the upper portion of the northern shear, and that was 60,000 ounces. When Luvem came in, they continued to mine down at depth in the northern shear, and then by drilling to the south, they discovered the top part of the zones 5, and so that was the second mine in the 80s. And then they sold the project to Cambior, and Cambior mined at depth. And they saw that the zones, broadened and continued at depth. But they also drilled to the south as the previous ones had done, and they discovered yet another series of economic veins to the south. And from underground, they were able to drill and to see that the 6N1 continued. I mention that because later on in the presentation you'll see that 6N1 has now basically tipped the project quite nicely. And you could read off some of the grades, the typical grades that these shear zones give. All right, I'll back what that would just to tell you what the next slide is. So the next slide is a vertical slice through the central shear zone, and we're going to be looking from the south to the north. All right, so you will see, there you go. The left-hand portion of the slide is that vertical slice I talked about. You could see the shaft at the surface, and it goes down to 920 meters. You can see the drifts that are branching off of it. Again, you could see what is in black here is ore, gold ounces that were mined that is no longer there. And that black surface represents about, or approximately, 300,000 ounces of gold. And then there's another portion that is a halo around that black ore. And you can see there's a lot of pierce points. That was done by the previous operator, Cambior. And so that halo around the black ore, well, I'll let you guess an estimate of how much of that mineralization is left in place. But it appears to me that it's quite similar to the black stuff in number of ounces. So hold on, yeah. So what we wanted to do from the very beginning is to make sure that our drill program was in line with our strategy. We had economic mineralization at surface, and that went down to about 800 meters. So we designed a program to test the vertical extension along the geometric plunge of that ore at depth. And for the past 18 months, we've been steadily reporting that the mineralization clearly continues and that we're getting grades and widths that were similar to that of the historical mine. And the right-hand portion of the slide shows another perspective in another direction. So you're looking from east to west. This slide here, and you can see that we came down with a pilot hole, and then from that pilot hole we did a whole bunch of branches. So we did 2 pilot holes and about 18 branches, and we were rewarded with considerable success. So I want to continue, and I'm about to end the presentation by illustrating what happened next. All right, so here's a screenshot of the 3D digital model of the mine. We have historically, there's about 4,000 drill holes and 60,000 assays. And that little screenshot that you're looking here, well, you can see that orange box, that's an isometric view. So you're basically slightly underground and looking up towards the sky to the north-northwest. In gray, you could see the shaft. In light blue, you could see the drifts coming off of the shaft. The yellow parts here are the stopes. That's the mineralized ore. And everything that's in red here, that was new mineralization that had been discovered, and it was about to be mined, but never was. And so phase 1 was, like I said, and in the previous slide, was essentially drilling along the most obvious target and the one that had what we believe would generate easy ounces. And you could see that we did 20 holes, and we had considerable success, and we still have results that are coming in. But the most recent announcement was 14.6 grams over 3 meters within a 5.8 grams over 10 meters. And so we're quite proud to say that, you know, that was what we wanted to do. Well, we clearly did. And then the second part of the phase 1 was to do some peripheral drilling to this main zone. And our target was this 6N1 zone that had historical drill results, quite impressive historical drill results, some that were taken at surface, and then drifts had gone out there and did some mining, and then some discoveries that had been done from underground. And we simply came in and drilled between the two pockets of ore. And then when we saw that, we said, okay, let's engineer another program at depth, as we had done in phase one. And a week or two ago, we announced some spectacular results, we believe, of 23.3 grams per ton gold over 2 meters within a 13-meter intersection that graded 6.6. So now we have a new zone that basically tips the economic possibilities of this project, because these ounces, or these potential ounces, are, within 100 meters from existing underground workings. And in our industry, when you want to access a pocket of ore laterally from your infrastructures, well, you could actually, the cost of developing from an infrastructure laterally up to 1 kilometer, well, the cost of doing that is the same as extending your shaft about 100 meters. So there's a 10-to-1 ratio. And so ounces generated laterally, well, essentially have more value and can generate better revenue than the ounces at depth. This project has both, as well as the leftover ounces from previous drilling. So now I'm going to end the presentation with 2 slides. And they're simply to give you a view of what we are about to deliver in the next few months. And that's results from phase 2 drilling, some creative thinking on the part of our management team to try to monetize this asset. So phase 2 drilling is actually a focus on 7 zones, 7 of the 23 zones, and it's the zones that we think are going to generate ounces more rapidly. The 6N1 is the zone that we recently discovered towards the end of phase 1 drilling, and we currently have drills on 5M4, and eventually we'll drill these other ones that are highlighted in red. And so and this slide is a simplified version of the previous, and is simply to have you focus on the fact that I'm going to present to you a slide, a vertical slice, a long section, a composite long section that will show you the main zone, which is in red, the new 6N1 zone, which is in burgundy, and the 5M4 zone to the east here, which is in orange. So here we go. So we're going to look at the left-hand side of the slide, and I'm going to walk you through this. So what we've done is a compilation. It's a work in progress, and I'm going to have you appreciate what we've done here. Again, in black is roughly 300,000 ounces of historical production. And visually, what we've done is we've outlined everything that the previous producer considered ore for future mining. And I'll let you conclude whether or not you think that the red stuff is equal in volume to the black. And so the design, the engineering of our program was to take this size target here, the 300,000 ounces of past production, and let's say roughly 300,000 ounces of potential production, and see if we have that same amount. Do we have about a 600,000 ounce target down in here? And the pierce points of the last 18 months of drilling below the mine are all shown here in red. And I think you can conclude as well as me that with the results that we have, well, visually you can appreciate that we've doubled up on what we had at surface. Now, the 6N1, which is, well, physically it's about 100 meters above of your screen, and and it is outlined in that reddish burgundy. And again, I'll let you conclude if that surface is equivalent to what is shown in black, which is 300,000 ounces of past production. And again, I'll have you appreciate the drilling that we're doing here at depth. Again, most recently, I think in hole 48 west, this one right here that I'm showing with my cursor, we drilled almost an ounce of gold over 2 meters within a 13-meter section that graded 6.6. And finally, I think the teaser for us is the new drilling that we're doing just barely 600 meters away from the shaft. This really nice zone here that appears quite smallish at surface, but we believe is getting much bigger here at depth. And you know, I'm quite confident that in January and late January, maybe February, we'll have results for our investors down in here. And so that's it. I mean, we said we were going to tackle this project with an aggressive drill program. We started in mid-2017. The program will continue until March of next year. We'll have drilled 50,000 meters, 100 drill holes, within 500 meters of a shaft on a legacy project that is close to infrastructure and qualified workforce. And that will naturally lead to added value, perhaps in the form of a new resource calculation. And then it's not as if it's the only project that we have. So we'll then start to focus on our other assets and hopefully have found a solution for Benoit. And I'll leave you on this for those of you saying, well, do you have the means to accomplish your ambitions? And the answer is yes. We have a very strong cash position of just under $9 million. And that is backed by a solid shareholder base. 17% of our shares are held by Agnico Eagle, 8.3% by JP Morgan of the UK, 13%-ish by the Caisse de Dépôt group here in Quebec, another 12-ish% by other various institutional holders. And then we have a very solid retail base here out of Quebec. So listen, my pitch here is, and our value proposition is, we've done good work. We've shown the project to have a potential to be the next mine on the Cadillac Fault. And we believe that 2019, if we are met with favorable market conditions, well, we think will be what we believe will reward the investors. So that's it. And I'm open to questions now.
Okay, thank you so much, Philippe. We have a question asking how many ounces are there overall in the old mine and under it, and in the structure east of the old mine?
Okay. Here is a graphical representation of the answer I would like to give. Obviously, you can appreciate that the level and precision drilling that we're doing right now will ultimately lead to a resource calculation that should be launched once we get the assays at the end of the program next year. But I don't have a problem estimating that we have a potential for 1.5 million ounces on this project. And from the very beginning, we thought that if we could only get to 1 million ounces, the project stood a chance for becoming a mine again. And this summer, with the discovery of 6N1, and now with 5M4, we think that this thing will become the next mine. there is about roughly 300,000 ounces of material that can be mined once you've dewatered the shaft and gone back underground. And so that provides you with several years of production before even, doing the development work needed to access the 6N1 stuff and 5M4. And heavens, we are going to be drilling other zones that are even closer to the shaft. So, I think it's all upside from here. Does that answer your question?
I think so, but if we get more feedback on it, I will let you know. So the second question is, could you please elaborate a bit on the stock options and the warrants?
Yes. Let's go here. The 3 million warrants that you see there will have all, there's about 1 million of those warrants that are lapsing in December. And the balance of them are all lapsing next year, I think mid-year. They're all at 27 cents. They're all broker warrants. And so by the middle of next year, they should not exist anymore. Or if they've been exercised, they'll have generated about $1 million of hard cash. And the stock options, well, their average weighted price, I went through the books recently, is about 17 cents right now. So they're not in the money, and they're tranches of about 1 million, 1.2 million options that were given to management and personnel and board of directors every year, and so every 5 years a batch of about 1.3 to 1.2 laps, and there's a rotation there.
Okay. The third question is, could you tell us something about the agreement with Agnico, which will end this month?
Yes, that's a very good question. When Agnico took an interest in us in December 2016, we have what we call an investor rights agreement, and that was filed on CDAR, so it's all the articles of that agreement can be viewed by the public. There are two main components, obviously, to that an agreement of that nature. The first is that they have a privilege to maintain their interest in Cartier up to, but no higher than 19.9% every time we do a financing. So if we do a financing, we advise them, and if they want to maintain their interest, they can follow. And they have that right as long as they do not get diluted below 10%. So as long as they have above 10%, they maintain the right to maintain or increase their position up to 19.9. The second component of the agreement is obviously what we call a standstill clause, where it prevents an entity, and they're quite common in the industry, from purchasing in the market shares, without approval. And so essentially they pick up shares when we finance. Now, when that agreement lapses in December this year, they still have the right to maintain an interest in us, but that standstill clause lapses. But there are other agreements that we have with Agnico that are non-disclosure agreements, and I think you could suspect that mutually beneficial to both parties, we've maintained those protective clauses. I think that answers your question, and without disclosing what is in a non-disclosure agreement.
Okay. Do we have any more questions? I haven't received any so far. If you do, please just send them now. Otherwise, you can always reach out to us by email. You will find my email in the follow-up emails or the the emails that I have sent you so far, please don't hesitate to reach out. I will direct the questions to Philippe, and we'll try to get back to you as soon as possible. And yeah,
Well,
do you have any?
thank you very much, everybody, and I wish you all some safe and happy holidays with your families. And we're going to wind up the year here and be drilling again by early January. I think our drills are taking a 2-week break. Towards I think the 20th, 21st of December. Guys are on holidays and they will come back on the 3rd. I wish you all a very Merry Christmas and safe travels. And I hope we do this again. And I do hope that we will reward you in 2019. Cheers.
Thank you so much, Philippe. It was a pleasure having you. And thank you again, everybody. And hope to see you in the following webinars. Good
Thank you.
evening, everyone. Bye.
Bye. Okay.